Thank you everyone for joining us for the first ever Tactical Trading Investor Forum here in London. This is our second event after a really well-received New York event last year. And we all have Harry Hagel to thank for kind of inspiring us to hold these series of forums. And basically, the genesis of this whole event was a little over a year and a half ago. Typhon threw a 10th anniversary party in New York. We did a little content, we had a big party, and a good time was had by all. And Harry's like, dude, why wasn't I invited to this? And I'm like, well, it was kind of, I don't know, I didn't have a good answer for him, right? And Harry's like, listen, we're not competitors. What we do is very complementary to one another. And what do? We do tactical trading. And Harry's like, the world needs to know what tactical trading is. As futures managers, we tend to get lumped in with trend following, with global macro. Some people think that everything that we do is extremely high volatility. And there's a whole subset of managers in this tactical space that kind of get pigeonholed, that don't get a lot of recognition in the investor community as being great diversifiers to portfolios. And what tactical managers do is that they're not trend following, they're not, in a lot of cases, taking directional views or long-term views, but they're looking at market structure, they're looking at relative value opportunities, they're looking even at fundamental commodity. But the big commonality through all of them is that one, they act in a risk-managed way, oftentimes with very low base volatility, and another is that their return drivers really have nothing to do with what's going on in broader equity or bond markets. They're driven by things like intraday auctions for securities, like the fixing of the gold settlement price. Things that when market stresses tend to occur, those opportunities actually tend to accelerate. So while they're not oftentimes directly negatively correlated to equities, and that's not really what you want a lot of time. A lot of times you want to be correlated to equities, especially in a 9-year bull market that we're in. But a lot of times in stress periods, those opportunities become more pronounced. So even though the return drivers aren't directly equities, maybe it's the second derivative of equity vol, and it's helping you capture premium in stress periods when your portfolio is needed the most. Also, tactical managers tend to be very liquid. They trade very liquid futures contracts. Usually the more open interest, the better for tactical trading strategies. So when you see broader stress periods, tactical managers tend to do very well too. And back in 2008, trend followers got a lot of credit for providing crisis alpha, they call it. But if you think about what a return driver of a trend following model is, a lot of them are looking at 50, 100, 250-day moving averages. The big trend followers really aren't dynamic enough to catch crisis alpha, except in 2008, they happened to be long bonds. Whereas tactical managers, you'll see managers here today that can adapt to things in seconds, if not minutes or a day or two. So they're much more dynamic and able to react in times of crisis. And with the market near all-time highs, why do I talk about crisis, right? Well, I think our job as investment professionals is always to be proactive. And just because equities have gone extraordinarily well and bonds have done really well since the crisis, that doesn't mean that that's going to happen indefinitely. And we've seen over the last 9 years kind of the epitome of asset bubbles, right? And a bubble isn't necessarily a manic push to the top like we saw in Bitcoin in 2017. Bubbles tend to develop over a long period of time, and we've seen just ever increasing asset prices in equities, in real estate, and whatnot. So the old adage is don't fight the Fed, right? And if you're a U.S. trader, why would you ever go against liquidity that's being driven from the Fed? And over the last 10 years, it's not just don't fight the Fed, but don't fight the ECB, don't fight the SNB, and you've really had this global coordinated quantitative easing, 0% interest rate policy, negative interest rate policy. So how do you fight that? And what is going to catalyze reversal of these asset prices. And to be honest, I don't know. I don't think really anyone in this room knows for sure, right? And I think that's kind of the whole point in tactical strategies. George Soros famously said, if you see a bubble, buy it, right? And a lot of people have bought it and they've gone with the flows and they've done very well. But the problem is we've seen a lot of concentration in trades. There's a lot of crowded trades out there. Long equities, long bonds, private equity, which, by the way, has very limited liquidity and is not mark to market. Private credit. Private credit, I feel, has been so crowded that next time we see a recession, we're going to see huge default rates that people's models, which are built in this long bull market recovery, have not fully modeled. So when I say take a strong look at tactical strategies, it's not because I think the market's going to crash tomorrow or I'm making any kind of broader market call. But I just think it makes sense to diversify your portfolios with strategies that don't have to pick tops and don't have to pick highs and lows, but could generate returns in any environment and tend to generate better returns in stressful environments. And I think tactical trading strategies, they're very hard to diligence, right? It's not saying, okay, how good of a stock picker is someone, or how good are the moving average models in a trend following model. They're a little harder to understand. It's a little harder to figure out what someone's edge is, especially if they're not going to go into their specific alphas. They're using an algorithm. I think it's tricky to diligence the operational risk, the technology risk in these strategies. But I'm hoping the content here today will help educate people here on how to evaluate these strategies, view them in the concept of a portfolio, and see how they could possibly be additive. And through this day, you're going to see a lot of great panels. We've got some incredibly accomplished speakers. You're going to hear about crypto. You're going to hear about strategy due diligence, both operationally and investment. You're going to hear about global macro outlooks of a wide group of portfolio managers who've got different market views and outlooks. And you're going to hear about AI and machine learning. You're also going to have a chance to sit down at roundtables with 5 different managers who are all in the space. Each of them has a different mousetrap, and I'm not going to speak for anybody here, but between us at Typhon, ALUM, AI Square, and SCT Capital, I think you're in for a treat for hearing how innovative the approach is and different the approaches each of these managers takes. So I want to thank our sponsors, Hedgebags, Sonic Group, CTA Intelligence, Alpha Week, 100 Women Finance for helping us bring this together and make our inaugural London event a success. And with that, I want to bring it up to my co-host, Joanna Thompson-DeCamone, to say a few words.
I'm not going to say many words, you've said most of them.
Oh, no.
I just